When you look at your phone and see that, the Nasdaq is up today, you are probably being lied to.
Yeah, quite literally.
Right. Welcome to your custom-tailored deep dive. Today, we are on a mission to decode the hidden mechanics of the stock market's most elite clubs, and we're using a massive shakeup happening right now, today, Friday, June 12th, 2026.
It is a massive shakeup.
It really is. The June Nasdaq 100 rebalance has just been announced, and, well, the number flashing on your screen and the index in your actual portfolio are currently playing by two very different sets of rules. Okay, let's unpack this, because we are going to move from the invisible mathematical rules of financial indexes straight down into the trenches with the deep tech companies that are currently experiencing explosive growth to earn their spot in that ecosystem.
Yeah, the gap between perception and reality in the markets is it's rarely as visible as it is during a major rebalance. Most investors just sort of assume that the Nasdaq is this one big monolith, right? But that ticker you see displayed on financial platforms or, the evening news, that's the Nasdaq Composite Index.
Which is huge.
Massive.
Yeah.
It is a broad market benchmark. It includes virtually every security listed on the Nasdaq stock market. So we're talking more than 3,000 companies.
Wow.
And it basically has an open door policy. Like if a company lists and meets just the minimal requirements, it enters the composite on its second day of trading. And it's weighted purely by its total listed market capitalization.
But that is not the index underpinning the vast majority of linked investment products, right?
Yeah.
Like if you hold an ETF or a mutual fund tracking tech, you are likely holding the Nasdaq 100 or the NDX.
Exactly. That is the critical distinction here. The Nasdaq 100 is a highly curated, very strict, rules-based index tracking only the 100 largest non-financial companies listed on the exchange.
Right.
It acts as the engine for over $600 billion in tracking assets. And it also drives over $623 billion in average daily traded notional value.
Okay, let's pause right there. Because average daily traded notional value sounds incredibly dense.
It's a mouthful, yeah.
What does that actually measure in plain English?
Think of it as the actual dollar amount changing hands every single day. So you take the price of the stock and you multiply it by the number of shares traded.
Okay.
If a stock costs $100 and it trades 1 million shares, its notional value is $100 million. The NDX requires massive liquidity because these giant index funds, they need to buy and sell millions of shares without accidentally manipulating the stock price.
That makes sense. You don't want to move the market just by trying to track it.
Exactly.
Yeah.
So to even be considered for the NDX, a security has to pass a strict 3-month seasoning period on an eligible exchange, and it must maintain an average daily trading volume of at least $5 million.
Right. I know the index also has concentration limits, but how do they actually stop a giant tech monopoly from just taking over the whole index? Like keeping the NDX from turning into a one-stock show?
Yeah, the NDX uses a heavily engineered, modified market capitalization weighting scheme. They employ what's basically a 2-stage cap.
Okay.
First, if any single company's initial weight exceeds 24% of the index, the algorithm triggers an adjustment to forcibly cap them at 20%.
So they just chop it down?
They just chop it down.
Yeah.
And then comes the aggregate cap.
Yep.
If you take all the heavyweights, so the companies that individually make up more than 4.5% of the index, their combined weight, cannot exceed 48%.
Oh, wow.
Right. If they cross that line, the methodology scales that whole top-heavy cohort down to 40%.
Right.
It literally forces diversification.
They also adjust for low-float securities, right?
Yeah.
I want to make sure I understand the mechanism here. Let me try an analogy.
Go for it.
Think of the Nasdaq Composite as a giant citywide music festival. Like if you have an instrument, you get to play in a tent. But the Nasdaq 100 is the main stage headline act. You have to prove your draw, season your act, and pass the bouncers.
I like that.
And regarding the float, it's like an election. If you have a city of 1 million people, but only 10,000 are actually registered to vote, an election should only count the 10,000, not the whole million. Is that how float adjustment works for these valuations?
That is a perfect analogy. The float refers to the shares actually available for public trading. So excluding all those locked up shares held by insiders or early founders.
Right.
If a company is highly valued, but has very few shares actually available to trade, the index caps its total shares outstanding at 3 times its free-floating shares to calculate its weight.
Interesting.
They are actively preventing a mirage of value, like a high price on very low volume. They don't want that distorting the index. What's fascinating here is how this structural design alters financial reality for investors.
How so?
Well, let's say a massive, newly public mega-cap company enters the market. Huge valuation, but a tiny public float. Because the Nasdaq Composite has no waiting period and no float adjustment, that new company will immediately juice the composite's daily performance.
So you will see the Nasdaq up on your phone.
Yes. But your NDX-linked portfolio won't feel that impact at all until the company passes its seasoning phase. And even then, its weight is going to be mathematically constrained by those float rules we just talked about.
Okay, so knowing how brutal this mathematical gauntlet is, who actually survived it in this June 22nd reshuffle, like, we are seeing a real changing of the guard, but what is the broader theme of this swap?
So the additions to the Nasdaq 100 are Astera Labs, CoreWeave, NBIS Group, RKLB, and Teradyne.
Okay.
And to make room for them, legacy players are being injected. That includes the cable giant Charter Communications, the IT services firm Cognizant, as well as Insmed, Verisk Analytics, and Zscaler.
Wow, some big names.
Really big names.
Yeah.
The theme here is an aggressive pivot. The index is shedding legacy digital service providers and rent-seeking models and replacing them with the companies building next-generation physical hardware and deep tech infrastructure.
I want to zoom in on Rocket Lab specifically, ticker RKLB, because they are replacing some massive legacy giants. What kind of numbers are they posting to justify this level of market validation?
Well, Rocket Lab just reported a record $200.3 million in revenue for the first quarter of 2026.
Okay.
But the metric that actually earned them their spot in the NDX is their backlog. It just surged to $2.2 billion.
Wait, really? 2.2 billion?
Yeah, that is up 108% year over year. The market reacted by sending shares up nearly 34% in a single day after the report.
That is, I mean, a $2.2 billion backlog is staggering for an aerospace company that isn't a legacy defense prime. What exactly are they building to generate that kind of future demand?
They execute what they call a tri-vehicle strategy.
Oh.
So the foundation is the Electron rocket, which is their proven workhorse for small satellites. I think they've completed 87 Electron launches now.
Okay.
Then they have the HASTE vehicle, which is a modified Electron used specifically for suborbital hypersonic testing.
See, I have to push back a little here. SpaceX gets all the mainstream headlines. They are the absolute behemoth. So why is Rocket Lab suddenly index-worthy? Are they just riding the coattails of the space boom?
If we connect this to the bigger picture, Rocket Lab is actually dominating a specific critical niche that SpaceX's massive Falcon 9 just isn't optimized for.
Like what?
Take the HASTE vehicle. They just secured a $190 million block buy for 20 hypersonic test flights from the Department of War, partnering with a defense technology company in Doral.
$190 million just for test flights.
Exactly. The government needs a high-cadence, reliable test bed for hypersonic technologies.
Yeah.
SpaceX builds buses, basically. Rocket Lab is building high-speed sports cars for specialized defense payloads. But honestly, their future valuation is really anchored to their upcoming Neutron rocket.
Right, the Neutron. I've read it's designed to take 13,000 kilograms to orbit, but what is the actual engineering ingenuity here? Like, why is the market valuing a rocket that hasn't even established a long flight history yet?
The ingenuity lies in the Archimedes engine that powers Neutron. It uses an oxidizer-rich, staged combustion cycle.
Which means what, exactly?
Well, in most traditional rocket engines, the exhaust from the pumps that drive the fuel is simply dumped overboard.
It just vents out.
Right, it just vents out.
Yeah.
It is incredibly wasteful. The Archimedes engine, however, feeds that hot, high-pressure exhaust gas back into the main combustion chamber.
Oh, wow.
Yeah, it is highly efficient and it allows the engine to run at lower stress levels. And lower stress means the engine can be reused multiple times with minimal refurbishment.
Which cuts costs.
Exactly.
Yeah.
That translates directly to higher margins and faster turnaround times.
And clearly the market believes the engineering works. I mean, they just announced a confidential contract for 5 dedicated Neutron launches and 3 dedicated Electron launches between 2026 and 2029. Plus, they're acquiring Motive Space Systems to bring space robotics in-house.
Yeah, the crucial signal buried in their recent earnings call is that the commercial manifest for this new Neutron rocket is filling up through the end of the decade, and get this, without management having to offer discounts to fill capacity.
No discounts at all.
None. When a company does not have to discount its future capacity, it proves it is providing a structural necessity. Rocket Lab is fully transitioned from this sort of aerospace novelty to critical cash-generating global infrastructure.
Okay, so Rocket Lab is doing this with massive rockets, but does this commercial validation rule apply to the micro-level tech that goes inside those rockets? Let's move from aerospace to semiconductor hardware, because I'm looking at a company traversing the exact same transition from R&D to market heavyweight, but on the Australian Securities Exchange.
Ah, you are looking at Weebit Nano, ticker WBT.
Exactly.
They serve as a brilliant parallel case study in deep tech maturation. They just reported their H1 FY26 milestones, and it really shows a transition out of the laboratory and into the global supply chain.
Wait, I have to push back here too. I am looking at their numbers, and they reported a record half-year revenue of $5.6 million. In the global semiconductor market, which is worth hundreds of billions of dollars, $5.6 million is practically microscopic. Why should anyone care about a company with that little revenue right now?
Because in deep tech, you aren't valuing current revenue, you are valuing the technological bottleneck they just solved.
Okay, explain that.
So Weebit Nano specializes in ReRAM, or resistive RAM. To understand its value, you really have to understand the physical crisis happening in chip manufacturing right now. The industry has relied on embedded flash memory for decades, but flash memory hits a literal physical brick wall at 28 nanometers.
What actually happens at 28 nanometers? Like, why is it a wall?
Well, flash memory works by physically trapping electrons inside a microscopic floating gate to store data. It's kind of like trapping water in a bucket. But as we shrink computer chips down to make them faster and more efficient, those buckets get smaller. Below 28 nanometers, the insulating walls of the bucket become so incredibly thin that quantum mechanics literally takes over.
Oh, man.
Yeah, the electrons just quantum tunnel right through the walls and leak out. So the memory physically breaks down, it becomes highly unreliable, and it generates massive amounts of heat.
Okay, so how does resistive RAM bypass that physics problem?
ReRAM doesn't try to trap electrons in a bucket. Instead, it works by changing the physical resistance of a dielectric material. When a voltage is applied, it forms a tiny conductive filament, basically the microscopic wire between two electrodes to register a 1.
Okay.
Apply a different voltage and the filament breaks, registering a 0. Because it relies on changing material resistance rather than trapping quantum particles, it scales down beautifully past 28 nanometers.
That's incredible.
It is faster, vastly cheaper to manufacture, and requires significantly less energy.
Which is exactly what is needed for AI inference. And just to clarify, when we say AI inference in this context, we mean the chips actually running the AI models inside your phone or your smart car, right? They need to process data instantly without draining the battery.
Precisely that.
Yeah.
Cloud AI requires massive data centers, right? But edge AI inference requires ultra-low power and high speed directly on the device.
And ReRAM solves that.
ReRAM delivers that. But having superior technology is only half the battle. The real inflection point is commercial validation, and Weebit Nano just achieved it. They licensed their ReRAM to Texas Instruments, which is a massive Tier 1 semiconductor giant.
Huge.
Yeah. They also achieved JGDEC's standard qualification at the DB HiTek foundry and got their first performing test chips manufactured on Semi.
See, I see terms like JGDEC qualification and taping out in press releases all the time. What do those milestones actually signify in the physical world?
Okay, so JDEC is the global standardization body for the microelectronics industry. Achieving JDEC qualification means the technology has passed hundreds of hours of brutal thermal and electrical stress tests.
So it's durable.
Exactly. It proves the tech won't fail in the real world. Now, taping out it on Semi is even more significant. Taping out is the final stage of the design process, where the actual blueprint of the chip is locked in and sent to the physical factory for mass production.
Oh, wow.
Yeah, it means a Tier 1 foundry has actually retooled its multi-billion-dollar manufacturing line to support this new technology.
Here's where it gets really interesting. If you put RKLB and Weebit Nano side by side, they are operating in entirely different realities. One is building 13,000 kilogram payload rockets, and the other is building microscopic memory cells that rely on quantum resistance. One is on the Nasdaq, the other is on the ASX. But they share the exact same structural narrative. They both survived the brutal phase of proving their engineering works, and now they are signing the massive Tier 1 contracts in the Department of War, Texas Instruments, that validate them to the global market.
This raises an important question for anyone observing the tech landscape right now. When does deep tech actually become valuable?
Right.
The maturation cycle tells us that the inflection point for explosive market valuation is almost never the invention of the technology itself. The true inflection point is the moment industry titans reorganize their own internal supply chains around that technology.
Right, because once Texas Instruments licenses ReRAM or Anduril buys 20 hypersonic flights, the rest of the market realizes the standard has been set. The urgency just cascades down.
Yes, exactly. Weebit Nano explicitly noted that their agreements with TI and onsemi have increased the urgency for other foundries to adopt ReRAM so they don't get left behind. And the same applies to Rocket Lab. Once you prove you can launch reliably without discounts, satellite operators lock in contracts years in advance just to secure their spot in orbit. It is a fundamental shift from speculative research to booked revenue.
So what does this all mean for you? We started today by deciphering the incredibly strict, mathematically rigid rules of the Nasdaq 100. We learned that the index relies on float-adjusted market caps and strict volume rules to measure sustained, massive commercial reality, filtering out the noise of low-float IPO hype.
Right.
We then saw those exact market forces applied to the explosive ascent of RKLB. We examined how the staged combustion cycle of their Archimedes engine and a $2.2 billion backlog transformed them into an indispensable launch provider, earning them a spot alongside the biggest companies in the world.
And we traced that same life cycle down to the atomic level with Weebit Nano. It proves that whether you are launching defense payloads into orbit or bypassing the 28-nanometer quantum wall with resistive RAM, the path to the top requires Tier 1 validation that rewrites global supply chains.
The next time you check your portfolio and you see a ticker moving or you see the Nasdaq 100 rebalancing, you now know the rigorous multi-year commercial milestones that actually move those numbers on your screen.
As we close, consider the broader signal the market is sending today. The Nasdaq 100 just systematically removed legacy cable providers and digital IT services to make room for space logistics, semiconductor innovators, and physical infrastructure.
It's a huge shift.
It is. If the most elite index in the world is actively rotating out of digital software to bet heavily on the companies building massive physical hardware, what does that tell you about where the global economy's most valuable physical bottlenecks will be by the year 2030?
That's a great point. Next time you see that big green or red number on your phone, remember, you're not just looking at a market average. You're looking at who just survived the gauntlet and took the main stage. Thanks for taking this deep dive with us.